Hi, this is Joseph. In this video, I want to share with you a strategy that I use. It's called the London Breakout strategy. And before I begin, please paper trade this or demo trade this. But I did want to give you this trading strategy. It's something that you can learn and within just a few minutes. I thought it was going to be a great opportunity to learn maybe a new strategy if you're not using anything like this that will help generate some profits when the market opens back up for trading after the holidays. So take advantage of the holidays, learn a new trading strategy, and this might help. So again, please paper trade it until you're really comfortable with it. I'm going to give you the specifics and the details of how to get into this trade. And then we're going to talk a little bit about how to improve the trade, meaning that obviously every trading system that's out there is going to experience a certain degree of losses. And one of the things that you'll come to realize, if you're new in the business, it's important that you understand these concepts because it's something to work towards. But if you've been in the business long enough, you realize that with every trading strategy, there's always going to be some losses. And that is usually due to the fact that that particular strategy, it works under certain conditions. So the optimum conditions would make the trade work better, and when the conditions aren't optimum, let's say the conditions just aren't perfect for that particular strategy, then you're more likely to experience losses. And you want to be able to master one technique so well that you can tell precisely when to use it and the conditions are optimum, and then you can also tell by looking at the charts and certain things like we're going to talk about today, looking at volume and things like that. You want to be able to identify when to stay out of the market and not use that particular strategy. It's like a tool. So you got a toolbox and you've got the right tool for the right job, and there's no reason to be using the wrong tool to try to get something done when it's not going to work. It's just not going to get you the results that you're looking for. So this London breakout strategy, I came about this concept and this idea. And I didn't invent this. There's many different ways to trade the London breakout strategy. I see lots of little programs out there on the internet for sale that will teach you how to trade the London breakout or the London open. I call it the London breakout. So it's the first, I'm using a 30-minute bar chart or candlestick chart, and I'm trading off of the first 30-minute bar at the London open. And I don't use this strategy on the euro dollar. And I want to show you how many trades set up over the last 9 days. So obviously, in a lot of videos that you see on YouTube, they cherry pick their trades, right? They'll go to the best trades and they'll go, look at how perfect this was. You can do this too. Well, I want to show you some of the trades that don't work and why they don't work so that you can avoid making that mistake. I want to show you, though, that this little system, this little technique is so effective, and it generates, it pops up almost every single day, where even if you do have a failed trade, the market will usually give you an opportunity to earn back that loss right away. You just have to be willing to jump in the opposite direction. What we're going to look at is a total of 9 different trades right now. We're going to start off with December 14th. So you'll look right here where I'm moving my cursor. There's a white bullish candle, small-bodied candle right there. You can see the X's. They actually identify the first 30-minute candle at the London Open. So at this point, this is the same thing that I was doing when I was trading futures back in 2001. I would wait for the first 30-minute bar to print, and then I would trade when it would break above or below that 30-minute bar. And I don't trade the split second that it takes out the high or the low. I wait for about a pip to a pip and a half, and then I get into the trade. So let's take this one for example. This one was actually a winning trade, and I'll show you the stop loss and the take profit levels. So right now at this point, we have a high of 1.3406 half. So I can't get into the trade until 1.3407 half or 8. That would be a point and a half. So from 8, if I got in at 1.3408, I would then use a 20 pip target. So from 0.8 with a 20 pip target, I'd be looking at a target of 28. So let's go ahead and see how this actually played out. So let me put the crosshairs in here, and we're going to roll this up to 28. And right here is 28. So you can see from the point in time we get into the trade, it hits 28 right here and then pretty much stops. Now, there is a way that if in certain conditions on certain days, if it hits the first target, sometimes it'll continue to trend higher or continue to trend lower depending on which direction it's moving in. If it hits the first target, I recommend scaling out of the position, locking in profits at the first target. Every single time, lock in profits at the first target. If it continues, you can scale out at the second target, which would be an additional 20 pips from the first target. So if our first target with an entry of 8, if our first target is 28, which is right here, our second target could potentially be 48 if it continues higher. Sometimes it does. It doesn't always, but in this case, sorry about that, that candle right there goes as high as 44. So it doesn't hit the second target. And that's why I highly recommend that no matter what, if you take a trade like this and you use this strategy, lock in profits at the first 20 pips. The first 20 pips from your entry, which includes that 1.5 or 1 point difference. So remember, I'm waiting for price to take out the high of the signal candle by at least 1 pip. Not as soon as it touches the high of the candle, because sometimes we see that happen, right? It'll go right to that high of that candle just like it did here, and then it could potentially reverse. So I wait for it to take out the high or the low of that first 30-minute bar or candle by at least 1 pip, preferably 1.5 pips, and then I calculate my 20 pip target from that entry. Now the stop loss. Well, there's a few different things that you want to be aware of with the stop loss. The pound dollar is and can be pretty volatile at different times. I would normally put my stop on the opposite side. So if it went back down a pip lower than the low, that would normally be my stop. Now, if we look at this one, it didn't give an entry of 8 on the next candle anyway, when it went back down and tested that low of the first 30-minute bar. So we weren't into the trade, and we weren't in the trade on the second candle. We didn't get into the trade until the third candle after the open. And you'll notice at that point, the stop loss was never really a factor. And that will typically happen. It will usually work out that way. So again, using about a 20 pip stop loss is sort of a general rule of thumb, but be prepared that every once in a while it will retest the lows and then go back up again, and it won't necessarily create a signal to go in the opposite direction, but it will test the lows. So again, this one didn't give an entry, even though it tested the low, so that was okay. We weren't even in the trade. We don't get into the trade until the third candle here. Each time it's going to be a little bit different. So this trade worked. On the 14th, this was a winner. It hit the first 20 pip target. So let's go over here to the 15th. This is the 15th. You can see that's the first 30-minute bar at the London Open. You can see it was kind of quiet over the overnight session. And then it starts to move down just a little bit prior to the open. Here again, the low of that bar was 1.3312. So I can't get in until about 11. If I get in at 11, then my take profit level, my first target, is going to be 20 pips away from that. So that's going to be 91. So I'm going to go ahead and put a price tag right here, and I'll drop it in there at 91. There's 91. So you can see from the time we get into the trade, you can see the retracement after it opened. The following candle opened, it went back up and tested the high, but again, it didn't give a signal to go in the opposite direction. It went back up. Again, the high there is 31. That bar right there goes as high as 29. So you're safe. You're good. The trend and the momentum is still in the same direction. At this point, it hit the target and gave an entry all within the next 30-minute bar, which is perfect. We like those. That, you know, we're getting in, we're getting out relatively quick. So this is a strategy. Again, if you can trade around or at the London Open, you're alert, your computer's ready, you're not in a hurry, you can set up and size up the market conditions prior to the open to make sure that you're looking at the right environment. And I teach exactly how to do this in my coaching course, to size up the environment so that way you can determine, is it the right environment to be using the London breakout strategy, or should you be using something else? That way you can avoid getting into the trades that would create the losses. I'll show you a loss in here in just a moment. So this one hits the first target, but it doesn't go down to the second target. The second target would be 71, and it only goes as low as 78. So let's go to the next day. So we've got 2 winners in a row. Let's go to the next day. The next day is right over here. This is on the 16th. And this was actually a losing trade. Let me show you what happened here. So there's the first 30-minute bar. And you'll notice that what happens on the next candle, it comes back down, gives an entry, but it doesn't go anywhere. The low right there was 81. So the entry would be 80, and it goes as low as 71. So if we get in at 80 and we're using a 20 pip target, it's got to go to 60, but it didn't go to 60. It only went to 71. So this would have stopped me out when it reversed and went back the opposite direction. Now, when it reverses and goes back the opposite direction, close out the trade, but then get back into the trade in the right direction. So the high was 1.3506. I can't get in until 7. So if I get in at 7, my first target is going to be 27 right here. And if it goes an additional 20 pips, the second target would be 47. Okay, so let's talk about the loss here. So if we see the first 30-minute bar and the low is at 81, we get in at 80. It turns around and goes back up, and when it reverses and it doesn't hit the first target, we get stopped out when it goes back up to 7, which is 1 pip above the high. That means we would have a 26 pip, approximately 26 pip loss. But it's giving us the opportunity to earn back the loss. So we have to reverse the position, get back in after we've taken the loss. We've already set our stop loss. We know we can get in at 7, and here it hits the first target. So the retracement doesn't stop us out on the pullback, and it continues to slowly move. It takes about 2-3 hours, and then it moves right in through the 27, and then it goes to the second target, and this high right there is 47. So within this 30-minute candle, it finally hits our first target and our second target. And this happens every once in a while. Now, I say this, if you're hands-on, and that to me means that you're sitting at your desk, you have a price alert a few pips before it actually hits the first target, and you've got your hands on the mouse. So you're managing this trade. If you're there and it's an open trade, and you see that price is moving right back up, I also teach you how to use volume so that you can track that this is actually going to be a big moving candle. It's going to be one of the candles that's likely to produce a bigger move in the sense that as far as the range from the low to the high, and it's likely to actually hit the second target. So remember I talked about earlier, if you're going to trade with both targets, you still have to lock in profits at the first target because you don't know if it's going to stop at the first target and never hit the second target. But in situations like this, I'll teach you how to read the volume so that you can see that participation's coming back in at that particular time. Maybe it's due to, let's say, economic data, whatever the case might be, and you can actually trade it, and instead of closing the entire trade at the first target, you could potentially trade it to the second target, and that's exactly what it did here. It gave you an opportunity to earn back 40 pips on the trade. So that's how we traded this, 40 pips on the trade, and we had a 26 pip loss. So we were able to earn back the loss relatively quick, and then some. And then we move on to the next trade. So the next trade on the following day was the 17th. This was a winning trade. You can see it right here. So we do it again. We see the first 30-minute bar. We wait for price to take out the high or the low. The high right there is 83, so we can't get in until 84 at least. There it goes up to 84. It actually puts us in the trade right here. We sit through this retracement. It doesn't give us a trade in the opposite direction because it doesn't take out the low of the first 30-minute bar, so we're still in the trade. And then it takes about 2 hours, and it starts to pick up that momentum again. So let's go ahead and take a look at this one. The high right there, 83. The first target is going to be right here at the 03. Sorry about that. The 03 level. And then the second target is 23 if it continues higher. And there is 23. That candle right there goes as high as 22.6. Occasionally it will do this. So you have to be prepared. Again, if you're up 40 pips on a trade like this, even if you are scaling out, I highly recommend not holding for every single last pip. If it looks like it's stalling just like that, and that high right there is 21, and then the next time it goes up to 22, and then it starts to drop to, let's say, 19, lock in the trade. Lock in the trade. Why mess around with it? We know it's not going to go indefinitely. There are ways that I will teach you how to read the markets to see if this is actually a top. That is one of the primary focuses in my trading course, is to learn how to identify tops and bottoms and turning points. That ability will tell you that you should probably close out this trade. This trade's over with at that point. So you could have picked up more than 20 pips on this trade. It really depends on where you would have identified the turning point, and if you have that skill to be able to read when it's going to turn around, and you should lock in profits, and that trade's over with. But again, this isn't necessarily a big, this technique isn't designed to create a lot of big profits. It's a good trade just to sort of warm up and start off the day if you can trade the London breakout or at the London Open. Many people can't. You know, I'm here in California, so it's really difficult. Midnight is when the London market opens. So a lot of people here on the west coast of the United States, they don't want to wake up at midnight. So it's not really an effective strategy for them. Again, that's fine. There are many other ways to trade. That's why we're focusing in on the point and figure opportunities. I'm going to show you the point and figure with the trade that developed today and the London breakout strategy. So I want to show you how that worked. So again, this trade right here, this worked just fine. It actually hit almost both targets, but let's just say it hit one target. That was on the 17th of December. The next trade here was on the 18th of December, and this one was a bit choppy. It create the head fake. That's the candle right there. That's the first 30-minute bar. You can see it closed up as a bullish candle. It's in a downtrend, but it looks like it's starting to slow down here and maybe create some short-term bottom pattern here. But it's still in a downtrend, so there's your little head fake, right? It goes right back up, and you get stopped out. It gives you an opportunity at that point to turn around and get back into the trade and earn back the loss. So here, the low was at 10, so we can't get in until 9. So we did have a loss to the upside. There's 9 on the downside. And we're looking for 89 as our first target right here. So it does give you the opportunity to earn back the loss. Now, if the candle's larger, I have to be totally transparent here. You have to be prepared for this. If the candle is larger on the first 30-minute bar, in other words, the range from the high to the low, if it's larger, chances are, in order for you to get a reversal signal to know where to get stopped out, you're probably going to be using a bigger stop. That's what I was talking about earlier. There's going to be some days where the range on that 30-minute bar is larger than it is on others. So you remember the day before here on the 17th, that range is pretty small compared to the range on this day on the 18th. So it could increase the stop loss. If you're trading it to a 20 pip target and that's all you get, it's possible that if you had a 27 or 28 pip loss, you're only going to earn back 20 pips. So you're -8, but you're always going to get an opportunity to earn back the loss on the next trade. Again, there are ways to identify if this trade right here is risky. I don't recommend and I don't teach my coaching students to take every London breakout 30-minute trade on the 30-minute chart. I don't teach them to take every trade because not every trade is effective. Not every trade. Some trades are more risky than others is the best way to put it. And again, it's because you have to be able to learn how to use it, master the system, and know when the conditions are ideal. I'm going to show you actually how to improve the performance and to identify how you can identify those risky trades so you can just stay away from them completely. There were several of these trades that actually failed initially that I would have avoided altogether. First of all, you know it's in a downtrend. There are other ways to identify that if this is just some kind of head fake, you would stay away from it anyway. So a lot of the trades that I show you that are actually failed trades here, you wouldn't necessarily have to take those trades. We don't always take those trades. We don't take every one of them. That's the key thing that I want you to take away from this is that, again, first of all, paper trade it, demo trade it until you're familiar with it and comfortable with the technique and the strategy. And then learn these other methods of identifying the riskier trades versus the safe, clean, perfect trades and take just the safe, clean, perfect trades that set up just the way we need them to. And avoid the ones that seem to be risky. Now you're also increasing your performance. You're eliminating a lot of the losing trades. This gives us an opportunity to earn back some or all of the loss. Let's go to the next day. So this is a week after. You can see the gap here. This is the week after. This is on the 21st. So on the 21st, this was a winning trade. No head fake. You can see here on the low, that was at 68. Now, here is the setup. So we have our first 30-minute bar. The low on that candle is 68. So we can't get in until 67. Here is 47. That's our first 20 pip target. And here is 27. And it actually goes lower. And my coaching students, many of them on this day, this was on the 21st, they were able to trail this a lot lower to trade. So this paid 40 pips on the move to the downside. Let's go to the next day. This was on the 22nd. And you can see right here in the middle, that's the first 30-minute bar at the London Open. Now, I think almost everybody would agree that this is a pretty choppy range. There isn't necessarily a trade here. It is moving sideways. There is a pullback. It was a bounce off of this support low. So there's a few things to consider. Is this a riskier trade as opposed to some of the other ones like this one here where it was in a downtrend? So that's something to consider. Again, you want to size up the environment prior to executing the trade, just prior to the London Open. That's going to help you identify whether or not it's a slightly riskier trade. And then, of course, we use the point and figure to enter with a very precise entry. So let's go ahead and talk about this one here. This was on the 22nd. The 22nd, again, was a head fake, but it did give us the opportunity to earn back the loss. So let's go ahead and you can see on the next candle, it actually goes up. The high of that 30-minute bar was 43. It goes up as high as 48. So it would have put you in the trade. But again, notice this particular day, the range of that candle, that 30-minute bar, was a lot smaller than some of the others. So the loss, the stop loss, would have been much smaller. So it's going to be a lot faster and a lot easier to earn back the loss. So again, it reverses, comes back down. The low is 18. We can't get in until 17. So here's our entry at, let me put it right there, 17. $97 is the first target. 77 would be the second target. And you can see how after just a few hours afterwards, it was a pretty fast move straight to the downside here, and it hit both targets. On the 30-minute bar, after it started to make that reversal and it started to move down, the movement was accelerating. It actually hit the first and the second target within that 30-minute bar. So again, hands-on, right? That's what I like to refer to it as. You're there at your desk. You're able to manage this trade. You already have your first take profit at 20 pips. Let's say you have it set in your platform. Now you can open it up, and as you see volume coming back in and you see the movement, you can trail this to the second target. So effectively, you really wouldn't have to close out the trade at the first target when you see this kind of momentum and you see this kind of volume coming back into the trade. So it would be a straight shot straight to that 40 pip target. So that paid 40 pips. So you can see how effective this is. This is a really fun strategy, a very fun technique. And like I said, you are going to see some losses, but it's going to give you the opportunity to earn back the losses. And additionally, I'm going to teach you how to identify the risky trades so you don't experience the losses anyway. Occasionally you're going to get tagged. It's just, it's impossible to see everything every year, every day, for your entire trading career. That's just the reality of trading. But you are going to be able to eliminate a lot of the failed trades, and you're not even going to get involved in those. You're just going to be able to you're just going to be able to pick very specific trade opportunities. So let's go ahead and go to today's trade setup here. This is the London breakout here again on the 24th of December. You can see that this one actually created an opportunity on the very next candle, took out the highs. The high right there, 84. So we can't get in until 85. First target, 0.5. Second target, 25. So remember, sometimes they hit the second target, sometimes they don't. It's better to just lock in the profits there. So again, on this candle here, you can see it was relatively quick moving, but we knew that it was topping out up here anyway. So it was definitely a good idea to scale out of the trade in this instance. Again, I'll teach you exactly how to see this long before it actually reaches the resistance levels. I'll show you how to confirm this. Now before we go, let me show you my point and figure and how it generated an entry on this one confirming the move. Now many of you know that I've been using point and figure for a long time. That's the primary focus of my trading course, and I want to show you why it's so effective. So this is the pound dollar. This is the pound dollar, and this is that entry to the upside. You can see how I got my entry. It was actually a double top entry, and it gave a second entry right here where I'm moving my cursor. Let me go ahead and put a circle in here. So this is what we spend a great deal of time in my coaching course, and when I do live coaching with my students, this is my entry right here. There's a very particular pattern that I'm going to teach you in my trading course when you use point and figure, and how to find a better point and figure trade as opposed to some of the other signals. Because we trade double tops, triple tops, double bottoms, triple bottoms. I show you exactly how to do that. I show you how to make a really good living off of trading just springs. Now, I rely on point and figure so much that I've got these charts, the point and figure, sitting side by side with my bar chart. So you saw that just a moment ago. I actually prefer to trade off of a bar chart. And here was my 30-minute breakout this morning. So let me go ahead and open this up. You can see it right here. That's the 30-minute bar. Sorry about that. That's the 30-minute bar. Again, I'm Pacific time. I'm in California. You can see the high there at 84, getting in at 85. It goes up to a high of, I believe, what was it, 18. So at that point, it doesn't hit the second target, but it does hit the first target, and then it reverses and comes back down. Again, if you put the crosshairs and line it up with that 30-minute bar at the open, you can see right over here inside of that circle, you can see the crosshairs, and they actually show you the same results. There's the resistance level right here. It actually creates a resistance level and then gives me the entry, a slight pullback, and then it takes off. And there's no mistaking when you use point and figure that you can clearly see support and resistance levels, and it keeps me out of trouble. So instead of looking at, let's say, a candle, when I sometimes see a wick poking through resistance or poking through support, sometimes you think, okay, well, this is it. It's about to break. It's about to move. I got to get in. And it's tempting. It's like bait. And a lot of people will get stuck on a wrong move. That some people refer to them as whiplash or whipsaw or head fakes. I like to call them head fakes. Those are, the situation where you get in, you think it's going to go, let's say, long. It's going to break out to the upside, and then it reverses and comes back down. Point and figure creates very, very solidified levels of support and resistance, and there's no mistaking. This is not based on, like these columns, these X's and zeros that you see, they're not based on time. They're based on the amount of volatility, and that's determined on how I created and set up this chart. So knowing how to create and set up your charts correctly, your point and figure charts, that's what's going to give you a more accurate reading. It's going to give you better levels of support and resistance relative to the time frame you're trying to execute. You'll notice that I'm doing this for day trades. Very often when I talk about point and figure to people that really don't have a good understanding of what point and figure is, their general understanding is that it just kind of gives you price targets on the larger time frames like the daily, weekly, and monthly. And it does do that really well. It also does it really, really well for day trading. And we use it to count our take profit levels so that way we're not holding onto trades indefinitely, wishing and hoping for more. How many times have you been in a really good trade? You're up 20, 30, 40 pips, and then you give it all back because you don't know where to take profits and you don't know where it's going to stop. Point and figure helps to eliminate that problem. You won't be giving back profits or allowing a winning trade to turn into a losing trade when you correctly use point and figure like this. So I'm using the point and figure at the same time I'm watching this London breakout strategy for an additional source of confirmation so that way I know I'm getting into the right trades. This helps me eliminate and stay away from the riskier trades that I showed you a moment ago on the other chart. Those London breakout strategies, the London breakout technique, those trades that failed, I stay away from them because I wait for a specific entry to confirm on my point and figure chart. That's one of the techniques that I teach my students in my new coaching program. So I'm going to go ahead and leave it here. This is, I think, a really great study lesson for the holidays. I think it's a great opportunity for you to go back and take a look at previous. Let's say you can go start with October or November, and you can kind of role play. Do it on a 30-minute chart again. Look for that first 30-minute bar, and again, we're using a 20 pip target. If it hits the first 20 pip target, we could then potentially trade it to a second target, a second additional 20 pip target. And again, keep in mind, the key here is knowing how to use this technique along with a few other things to confirm a risky trade versus a better trade opportunity so that you can avoid the risky trades that usually fail. Thanks for watching this video. I hope you have a great holiday, and I hope that 2021 is a super prosperous and profitable year for you.